Welcome. My name is Sasha Moore, and we're here today with Chris Levy, SMSF expert and partner at Aquila Super, to hold the Unpacking the Big Issues for the Financial Year 26 live webinar. But before we start, let me tell you a little bit about Chris. Chris holds a Bachelor of Commerce from ANU. He's a chartered accountant, a registered SMSF auditor, and recognised as an SMSF specialist auditor with the SMSF Association. Chris established Aquila Super in 1997 in response to the growing demand for independent accounting practice that could provide specialist audit and compliance service for SMSFs, and now responsible for audits and business development. Welcome, Chris.
Thank you, Sasha. Yes, good to be here. Yeah, look, welcome everybody. It's another year down, and good to be able to do this sort of I think it's our third or maybe our fourth sort of post 30 June, audit webinar to get ready, batten down the hatches and get ready for the next season. And look, I have to say this last year for us and me personally, it's been a good year and also a tough year. The good aspect is I managed to snaffle the SMSF Advisor, SMSF Auditor of the Year. Which is I'm very appreciative of it, but I'm also very surprised. Because of the caliber of the other nominees, but also because look, it's been an incredibly tough year. I don't think if you measure the level of work that we've had to do by how many late nights we've had to do and weekends. I think myself and auditors generally have been putting in huge hours, and unfortunately, it hasn't necessarily translated into getting those audit turnaround times down. It's actually kind of blown up. So look, apologies to to all my clients that's happened, and I guess part of the reason for that, or big reason, is because when these audits come to us, they're hitting these barriers. They're hitting, there's things missing, things haven't been done quite right, and that's what this webinar is about. This webinar is not a technical session on valuations or the Div 296. It's more about, or the goal of it, and it has been pretty much every year we've done it, is to try to get the audits done like cleaner, smoother. Like the actual work that's coming to us is able to get through quicker. Because when that's not the case, inevitably we throw it back to you guys, and back to the trustees as well. And it's not a nice feeling. We don't like doing it, but at the end of the day, we do have that pressure on us from the regulator. And to be honest, our files have to be close as perfect as possible, or we run some fairly some risks of getting in trouble. So I guess that's the main point I want to convey. That look, it's about as I go through these, the big elephants, so to speak, and hopefully those rats and mice at the end, it will be all about just trying to make the work papers that you're giving to us more complete and satisfy the expectations we have, so we can get them out the door soon.
Thank you, Chris. But before I'm just going to segue for just one moment.
Yeah, sure.
We've had quite a few pre-registered questions that we're going to aim to get at the end. But one of the things that we also love is just questions coming throughout the webinar. So if we don't have a chance to cover everything, we'll aim to get back to you with responses. So please be sure to use the Q&A function, and I'll either feed that through to Chris as we're talking about the respective sections, or hopefully we'll get through to the end. So Chris, you've got a lot on your plate.
Yes.
I'm going to hand the reins over to you, and let's get into it.
All right, thank you, Sasha. And look, I think I had a quick squeeze at some of the questions people have already put down. Not surprisingly, a huge chunk of them is Div 296. So before we get into the sort of audit issues that we've been dealing with, we're going to have a slight detour to the fetid swamp that is the Div 296. And I guess it's in a way it's a little bit surprising that I'm being asked about this, because it's really not an audit issue. It's not there are some I guess you could argue that if there's a big Div 296 liability, maybe it should be in accounts, etc. But generally, no. It's one of those rare instances where we auditors can sit on the sidelines with our packets of popcorn and watch the poor business services accountants wrestle with it. But having said that, quite apart from the questions that have come through from all the attendees, for the last month, I've been getting so many phone calls and emails about this subject. So I figured that, look, it's happy to spend a bit of time on this because I guess we're also getting insights into what some of the other firms are dealing with now. I just want to say, look, this isn't. I won't be focusing on how the Div 926 is calculated. There's smarter people than me that are doing presentations on this, and also we still don't have all of the notice of advice and regulations and stuff coming from the ATO to actually calculate this, particularly in areas such as defined benefit and that kind of thing. Supposedly they're coming, but the technical side I'll leave to others. But I will be focusing on the Div 296 cost-based reset. That is very much front of mind, and it sort of seems like all the business service accountants have sort of nailed down the 25 lodgements, and so sort of like the eye of Mordor sort of shifted across to this thing, this big Div 296 reset, because it is a significant option available to trustees. I just want to sort of cover this for a bit. Now, I guess the first question we get asked, and actually before I get onto that, as most practitioners know, it's this one-off. It provides trustees the options to effectively quarantine the capital gains that have built up prior to 30 June 26. And look, that may be very significant, it may not, but it does feed into there's this main question I'm getting about, well, should my clients get it, adopt this? And look, I guess there's a lot of element of common sense in relation to this. If you have clients where their member balance is more than 3 million and there are substantial capital gains, unrealized capital gains, in the self-managed super fund that supports those member benefits, then look, yeah, that's a clear candidate to take, go for this reset. If that's not the case, if the members have only got $1 million or the actual, rather than an unrealized sizable unrealized capital gains, this unrealized capital losses, that's a clear case of, well, you probably don't want to take up the reset. Again, very much common sense. But then there's sort of people in the middle, and this is where I've noticed practitioners struggle a bit. The truth of the matter is there isn't a clear answer. It is very much going to be, should be decided on a case-by-case basis. And the sort of examples I've had is where you've got members that are just slightly over the 3 million or close to the 3 million, but the unrealized CGT gains are quite small. And so the accountant's sitting there going, well, there is an advantage, but there's extra costs that are going to be associated with doing this. And look, the reality is you can't answer that. It is very much going to be be done on a case-by-case basis. There is going to be a special situation for those funds with portfolios. I'm going to talk about that in a minute because it's a bit of a mess. Yeah, look, it's not sort of a situation with simple answers for some clients, close to that $3 million mark. I will just also say that that choosing to take up the option of the reset, it's an all or nothing. You can't, unlike the 2017 cost-based reset, it's not, you can't cherry pick assets, the whole thing or nothing, which in a way, from an administrative point of view, actually makes things easier. And the other thing is it's irrevocable. So if you lodge this election, can't be changed. Okay, now in terms of timing, so the election needs to be lodged with the ATO. It doesn't sit on your permanent file and that's it. It actually has to be lodged with the ATO prior to the lodgement date for the 27 tax return. So practically speaking, for most funds, it'll be May 28. It could be February for new ones, could be October 27. But look, the reality is we've got 1.5 to 2 years. So there's stacks of time to get this form in, which is good because, look, the form hasn't been prepared yet. The ATO is still putting it together. Just talking to others in space, they're sort of like, well, maybe because the ATO hasn't finalised some of these more exotic and sort of unusual situations, again, like for the, say, defined benefit type pensions, they can't actually finalise the form because you can't have a basic form and then sort of like an extra form. I mean, they could, but it's unlikely. They want it all in the one form. So, yeah, people have sort of said, oh, well, look, probably next month or two. I'm not so sure. But at the moment, if you have clients coming in, and we have had some client firms where this has come about, where they, these eager beaver pensioners that want their refund checks, they've brought their 26 information in, they want the whole thing wrapped up, and that, that's happening. And the accountant wants to, tie up all the loose ends, including the lodgement of this, Div 296 cost-based reset form. And they're sort of finding, oh, well, they can't do it. So in first instance, yeah, the ATA form, doesn't yet exist. And then secondly, the software is still being finalised. Now, my understanding is that if you're using the Class software, that's actually a bit more advanced, and they've sort of got all of the fields ready. And it's not surprising because it's sort of more of an administrator's type system, but they're ready to go. But of course, you can't actually put it in the form yet. BGL it's still being developed, and what we've been told, what we've heard, is that they're sort of aiming for the December quarter, so another couple of months. Now, it's entirely possible that both the ATO and the software providers have been relatively relaxed about this, recognizing that there is that sort of 18 months, 2-year delay when you actually have to required to lodge it. So they're taking it a bit easy, but it does create a bit of a problem that some other practitioners sort of conveyed to me, that it's one of those situations where, well, you can lodge, let's say you lodge for 26 tax return, and the lead up to, say, Christmas, and the lead up to this, to the software providers fixing up the software, and then the form has to be lodged later. They're concerned that this might slip between the cracks, and I mean, this happens. You get a partner that's sort of expecting the senior manager to look after it. The senior manager's leaning on junior staff or an admin team, and it just kind of, it could fall between the cracks. And so I guess what I'd sort of suggest to business services practices is make sure you do have a process in place, a register, with printouts and things, so that come, say, a year's time, when it is starting to get critical, that you can actually go back and just make absolutely sure that these forms have been lodged. Because you can imagine what would happen if they do slip between the cracks. You could have clients with sizable unrealised CGT liabilities where they miss out on this opportunity. So look, just be mindful of that. But yeah, at the moment, you can get all your CGT data ready, but you can't lodge that form. Final point I'd make about this is that the form, once it's lodged, once it's prepared and you lodge it, you need to hang on to it for 5 years. Our advice would be, look, hang on to it forever, quite frankly. Stick it in your permanent file and don't lose it. Now, I guess one of the other big questions we get relate to sort of valuations, and there's a sense that because it's a big thing, there's that somehow the valuations need to be done differently. And look, that's just not the case. The valuation rules, they're already very stringent, and I'm going to talk about them in a minute, but you can sort of just continue to when you come to valuing assets, you just apply the same sorts of rules. I guess the obvious thing is that if there's 1 year you're going to dot your I's and cross your T's, this is the year to do so. So yeah. Now, let's have a look. Now, actually, before I do get into valuations, I do want to just actually veer into another area that, again, it's not so much an audit issue, but it's causing grief to accounting firms. And I'm very surprised to be in this position. I expected the various players to have sorted this out, and it relates to the portfolios. And I was banging my drum on it about a month ago, one of sort of our releases, but. Dealing with this CGT reset, where you have clients in one of those portfolio systems, the Hub 24, the BT Panoramas, those kind of things, it's either going to be non-issue or it's going to be a massive headache. And let me explain. So if you are one of those rare accountants well, the minority of accountants that are using the Class software, and like with those portfolios, you've actually broken the portfolio apart, and you're getting data, typically getting data feeds from the portfolio manager, and it's going in the Class system, and all the investments are separated. You're going to be fine. And in terms of actually being able to record and track the Div 296, resetted cost base, as it were, because the system's all set up for that, and you can just not just the actual reset, but the tracking of it year to year to year, and so you can just play on. If, however, I'm fairly sure the majority of accountants that don't do that, that have sort of said, well, why should we, unravel the portfolio and sort of track everything sort of separately when the portfolio system's already doing that? And that makes perfect sense. I mean, in a way, you're doing a solid for your clients. You're generating all these extra costs when the actual portfolios are doing all the heavy lifting. If you're in that situation and for your account, you've got a one-line item for your portfolio, and again, I believe at least 70% of the clients I see do this, probably a lot higher. And typically they're on the BGL software, which again is the most popular. If you're in that situation, you've got a real problem with tracking the CGT reset for a number of reasons. Now, when the Div 296 rules were first sort of being floated around and people were discussing them, I was convinced that the portfolio services, again, the BTs and the Hub 24s, that they would track this. Why? Because they have all of the information there. They seem to handle the CGT reset for 2017 perfectly okay. But this year, notwithstanding the fact that it's simpler for them, it should be simpler. It's not sort of the trustee having to tell the actual fund manager, oh, I want this asset reset and this one. It's the whole thing or nothing. So it should be easier for them. They have all the data there. Notwithstanding all that, I don't know, they seem to be running silent on it. This was raised by one of our good client firms back in March, and one of the big providers, they sort of said, oh, well, look, we've heard about this, but we haven't decided what we want to do, and it's quite surprising. Another one actually said that another portfolio manager said, look, we've made a decision not to do anything about it. So it's bizarre. It's bizarre. So if that's the case, again, what I thought is that the portfolio managers would produce a report. They would actually say, look, based on your assets, here is what would you call it? The Div 296 capital gain amount to put into the tax return. And so again, the accountant and the trustee wouldn't have to do any of the heavy lifting. That's not the case. So what happens is if your client has large unrealized capital gains in a portfolio service, the pressure is going to be on the accountant to actually keep track of that. Now, again, you can't use a portfolio service. So what you do, you have to break it apart. And there's now the BGL system can't. I mean, you could actually kind of break it apart within the BGL system, but what it means is you have to veer away from that one line item. So yeah, look, that's an option. Other accountants have sort of said, oh, well, maybe if we keep Excel spreadsheets or other sorts of working papers, we could kind of track it that way. My suspicion is it's going to be incredibly onerous. It depends just how much activity goes on in the portfolios, and when you've got SMAs of 20 trades a day, I don't even know if that's going to be possible. So look, that is a dilemma, and it is, if you are an accounting firm that is using the one-line item approach to accounting for portfolios, this is something you're going to have to address fairly soon. On a number of different fronts. One is resourcing, because you're going to have to go into your accounting software and again, unravel everything, and you don't have the cost bases, in there because you haven't been tracking it. You're going to have to go back to the portfolio reports to get that. You're going to have to go back and do there's a client management aspect of this where you're going to have to tell these people, yeah, look, I'm sorry, your fees are going to double. There are aspects of this that you as a business services provider is going to have to sort of consider. So yes, sorry for throwing that in there. But yeah, I'm very surprised that we're in this position, but it is what it is. Okay. Look, and before I do go into the valuations, I just want to. I've had some questions from a few accountants about providing for, like having a provision for Div 296. And look, it's a great question. I did think about this before. I don't know whether it's necessarily going to be a material amount in the financial. So again, I don't know if it's necessarily an audit issue, but accountants have said, oh, look, can we deal with this? I have heard some people say, oh, look, it feels like we're being sneaky and it's a bit mischievous, and I'm very much of the opposite opinion. I think if you go back to sort of general accounting principles, that and well, in the first instance, you compare it to provision for deferred income tax, which a lot of accounting firms are doing, and you sort of think about, well, from when you're considering putting a provision in the financials, it needs to be based on whether being able to estimate a liability accurately and also a high probability that it's actually going to come to pass. And look, I would argue that the provision for deferred income tax, even though it's generally well accepted by our profession, there is some doubt as to whether it will actually come to fruition. Simply because in a lot of instances, accumulation members become pensioners, and that provision for deferred income tax effectively evaporates. Whereas with a Div 296 liability, at the end of the year, you can pretty much nail down exactly what it is, and you're fairly confident that you're going to get smashed with it. Now, there is a question mark that I've heard some say, well, how do you know it's going to hit that particular self-managed super fund? 95% of cases, it is. And the member says, look, yeah, if I get a liability, that's where I'm going to take it out from. So I think in terms of the certainty of the liability coming to pass, my personal view is that, yeah, it's very strong. And in fact, in many ways, a provision for deferred income for Div 296 shares the same characteristics for provision for income tax, and no one questions that at all. So look, I believe there's a very strong arguable position for accounts if they wanted to include a provision for Div 296 if they wanted to. I don't know, maybe the ATO will have a different position in the future, but that's my sort of current thinking. So getting into those audit issues, and I'm going to be talking about valuations. And again, what I'll be talking about will be applicable to the valuations you're going to be doing for this Div 296. So it sort of serves two purposes, as it were. And look, I'm going to kick off with residential valuations first, not because it's been a problem. I have to say, for the most part, the valuations we get from yourselves are generally pretty good. Most people have a reasonably solid understanding of what we need, and there's plenty of online research. What I'd sort of say is, look, in an ideal world where you are going online to get this sort of cost-based data or comparative sales type data, try to get from two places. There's about 4 or 5 decent real estate type websites, and having more data points is always good, and just check that the actual confidence level is medium to high, medium dash high, and that's the ATO expectations. Where we do get problems is where an accountant will give us this online report, but the confidence level is low, medium, and essentially means we can't really use it. So look, be mindful of that. That we do need a high confidence and/or multiple sources. So yeah, so residential is fine. Now business properties. Now this I sat down and I worked out, well, in a given week, how much time am I spending on these different problem areas? Look, honestly, 50% of my time is spent sorting out business property valuations. It just seems to cause grief to trustees and accountants I mean the rules about what we as auditors will accept and what the ATO expectations are, they've been locked in place for a while, and so it surprises me we're still having to deal with this. But notwithstanding that, yeah, it's been a huge problem. And the problem there is basically when it comes to business property, can sort of fall into three buckets. One is the timing of the valuations, like how regularly they're getting done, and how essentially how close they are to 30 June. The second aspect, which has become much more of a problem, is the quality of the valuations, and I'll address that in more detail in a minute. And look, I guess the final aspect with business properties are lease-related type issues. And again, it's just the lack of stuff that we're getting is just slowing down the process. Now, the obvious problem for when a client has business for a property is that there's just like a real lack of, unlike residential, there's a lack of online information on that specific property. In fact, there's usually none. Obviously, exception to that is where what we used to call the RP data, which is now done by Cotality, where you can go in and get research. But even then, they don't provide valuations either. So I guess what we're really left with is that when it comes to the responsibility on trustees for valuations, you really are left with valuations from property professionals, with those comparative sales. So that's it's all like the cornerstone, the bedrock of a valuation. And we've had some clients, some trustees where they push back on that, but that really is it's imperative to get that. So in terms of how often valuation should be obtained, most clients should now be aware that the 3-year rule is dead. Like, it's, in fact, the argument has never been in place. It's just something that we accountants dreamed up. Look, that may or may not be the case, but you can still, I guess in theory, you could still get away with a valuation every 3 years, but you've got to be very careful. I guess one of the key things is that what are the ATO expectations in terms of valuations? What do they want to see? If you're doing a valuation at 30 June, you're looking at sort of comparative sales and whatnot. What's the sort of time period? Now, they haven't actually ever mandated that time period. They've also explicitly said they don't expect valuations to be done every year, but in various forms of communication, it seems like the window is 6 months before and 6 months after. So in a practical sense, if you are looking at valuations for 30 June 26, with an eye to that Div 296 reset, ideally the comparative sales that they're going to, that you can rely on, basically between January 26 and December 26. Like, that's not a perfect world. Now, if you had a valuation done last calendar year, say October 25, a lot of accountants would think, oh, well, that can be used for 30 June 26. Look, the ATO position seems to be that, well, not by itself. Like, it's very, very persuasive. It just doesn't get over the line. And so what you need to do is supplement that with additional data, I guess, and that can come in the form of various things. It can be sort of property research on that particular market and geographical area. So, for example, we've had one where it was an industrial warehouse in sort of inner Sydney. Well, they had a report from one of the big commercial property agents that talked about the movement over the 12 months and apply that percentage. That's helpful. Comparative sales around that time, the movements there, or say, for example, the per square meter cost of a warehouse, let's say, from a sale in June 26, where you apply that to, or take the movement of that and sort of use it to support a valuation done in, say, October 25. So essentially what you're doing here is you're making an argument. You've got to sort of imagine that if the ATO was to review it, you've got this solid argument to back up what the valuation is for, say, 30 June 26. And look, this has been the case for a while. So yeah, look, I guess what some accountants have done is they said, oh, look, it's all too hard. And what they're doing is they're getting valuations done every 2 years. Typically that's like towards the end of the calendar year, start of the calendar year. So there's that sort of window between November and February, and they're getting evaluation done then, and then they're using it for the year just gone and the year ahead. And look, I'm relatively comfortable with that. Again, if you want to push that forward to 3 years, you're going to have to provide that additional information, or yeah, we're going to have pushback. I will also say as well, one of the sort of the concerns that accountants have said to me is, oh, Chris, is too much, and poor trustees, and they shouldn't be up for thousands and thousands of dollars of valuation fees, every 2 years or even every year. Look, what I would say is you probably need to explore some of the online property valuers. There's some very good ones out there, and I'm happy to provide details later on if people are interested. We're sort of talking about $500 for a commercial property, and depending on which ones, look, they're not just extracting information like an AI system and coming up with a figure. There are some that do that, and we have had problems with them, but others we've managed to sort of look under the bonnet, and they actually do a solid job. And so, $500 odd every 2 years, it's not it's annoying, but it's not hugely onerous, and it solves the problem. So consider that. Speaking of AI, I have noticed an increase in trustees/accountants using AI to either do valuations or more commonly to generate more data for those intermediate years. So you get a valuation 1 year, and then it sort of goes over the 12-month period, and they're using this AI generated argument, for want of a better word. And look, they can be excellent. They can be really good, but like most things of AI, you've got to take it a lot with a grain of salt. And if you are to do that, you really need to make sure that you push the AI to provide the sources for where that comes from, and then potentially actually print off those sources. Yeah, essentially, again, you're making an argument, but it needs to be based on solid data. And so, yeah, look, I think one of the sort of takeaways is, I would encourage accountants to get familiar with the AI, recognizing that it's not the be all and end all, but it has generated. I have seen some reports that are really solid, and they provide some good evidence to support a 30 June valuation. Okay, so that's in terms of the timing. Okay, now with the quality, now this is so, okay, let's say, we receive a job, and we're looking at a valuation report. The trustee's gone off and, done the right thing, and, obtained a valuation report from a property professional, let's say 4 months out from 30 June. All looks great, big logos on it, it's 20 pages. Definitely not 20 pages, but a couple of pages, but they've specifically cited comparative sales. And at first blush, it all looks good. But the ATO have raised this as a serious concern, that sometimes these comparative sales are just they're not comparative. And look, this is, in a way, this has been a blind spot for myself and a lot of our auditors, like in the years, that if it looks good, if it looks professional, it's sort of, and at first blush, it sounds like a comparative property, we just sort of let it go. But what we've found is when you break down, say, the per square meter cost of the net lettable area or the total block, or they're not matching up. They're quite broad, and there's been lots of instances where we've had to, unfortunately, push back and say, look, I'm sorry, accountant, this is rubbish. We can't. These comparative sales don't actually support the value. And the sense I get is that a lot of these property owners, they're coming up with a value based on their gut feeling or yield analysis, which that's the way they normally value properties, and then they're sort of trying to get comparative sales to kind of bolt on, like that bit of greenery on top of your steak, sort of put it on and hope that everything's going to look fine. And anyway, ATO focused on this. We're now focusing on it, and other accountants as well. And look, it's what I would encourage is for yourselves to have a look at it as well before it comes to the auditor, because what you can imagine what happens. Like in the first instance, we're spending a huge amount of time actually doing this process. I did one last week, and it was an hour and a half on a warehouse, because there was about 3 comparative sales, and it's very time consuming. And it slows the whole audit down, and it creates a lot of frustration with the client. They're sort of thinking they've done the right thing. and we're having to push back on them and saying, I'm sorry, I know you spent all this money, but the actual report from the property guy is rubbish. And yeah. So look, just be mindful of that. Um, what else is there? Oh, the other big issue as well with these comparative sales is that they're not recent. I had one about 6 months ago for a 30 June 25 property. The comparative sales were from 2021 and 2022. Look, just no. Again, I guess we would sort of expect and hope that accountants would look at these valuations and just go through the comparative sales. And if they're too old, again, you might have to go back to trustee and say, look, I'm sorry, get this guy to redo it because yeah, it's just not useful. Look, one of the questions we do get a lot, and I think one of the questions in the seminar was, well, what happens if there aren't any comparative sales? And look, this is a perfectly legitimate concern. We've seen it quite a lot, particularly with regional areas, regional business properties. There doesn't seem to be that liquidity. It's not surprising. There just isn't that liquidity in some of these regional areas. And what can your clients do about that? And if there isn't that comparative sales, unfortunately, you can't sort of fall back to yield analysis, especially when there's it's a related party tenant. Yield analysis can be useful where there isn't where the tenant is unrelated, but not by itself. And so where you're in a situation where you just don't have the data and the trustee, despite their best efforts, and the property professional, despite their best efforts, they just can't find anything. You're in this dilemma because the ATO position is, look, here's the bar, here's the minimum we expect to get over this valuation line. And if you can't meet it, despite your best efforts, it's just going to be qualification. And I know it's annoying and it's frustrating, but it is what it is. And I will say the actions of the ATO, or the lack of action rather, on investigating funds in this space where they have had this situation where they don't have comparative data. I think they understand it as well. Like basically, what happens is we'll do a qualification, we'll send off a contravention report, we'll explain the situation. It seems that I'm yet to amongst like ourselves and other auditors I've spoken to, I'm yet to see an instance where the ATO actually take action against that trustee. I mean, they send out rude letters about fixing it, but they're very generic. So, but yeah, be mindful about that. Okay, so that's in terms of quality. Now, look, the third big issue that does just slam on the brakes when it comes to us doing an audit are the leases. Now, the regulatory sort of background to this is that the ATO, they want us to make sure. If an unrelated tenant, they want to make sure that the tenant is in fact unrelated, and the way you do that is by looking at the lease and looking at the parties, and that's the best evidence available to us to do that. So yes, we need to get the lease for the year that we're auditing, and look, they should. Most trustees should have that, so it shouldn't be that onerous. Where the tenant is related, well, obviously the risk profile goes through the roof, and this is a big focus area of the ATO. This is where, how you put it, sort of non-arm's length type transactions can occur. So in the very first instance, they want to see a written lease, and we need to have that on file. And I guess when we get that, we will be looking at whether annual CPI increases have been done. We'll be looking to make sure that the rent has been there's been some sort of market appraisal, an agent's done a rental market appraisal, so the actual amount is commercial. I have to say that's been one of the big problem areas. Where you get a lease turning over or a new lease executed, in a lot of instances, the trustees just kind of worked it out themselves and said, "Oh, well, this sounds reasonable based on Johnny down the street or whatever." Look, it's not good enough, and this has been a bit of a problem here. So be aware of it. And the other one relates to outgoings. With a lot of instances where the lease explicitly states that the tenant is responsible for outgoings, and yet the fund ends up paying for it and not being reimbursed. And I get the obvious sense that the trustee is like, well, it's all my money, it doesn't really matter. And yeah, look, it does. And so again, that it slows down the process when that stuff happens. And I guess what in my perfect world, the accountant would be talking to the client where they have these related party tenancy type things, and every year just making sure they actually follow through on what's going on. In relation to the rental appraisals, you get these situations where the lease will finish and there's like a gap. There's like there isn't a new lease that follows on immediately. Because again, the trustees are like, oh, well, it's all my money. It's, there's no risk here and that kind of thing. Look, there is a concern, and where the it relates to the way the in-house asset rules work, where a business property is not exempt from the in-house rules just because it's business. There also has to be this enforceable undertaking, and that's actually written into the law. And so there's an argument that where there isn't a lease, that the lease finishes, that the asset can become immediately an in-house asset. Now, that's a bit extreme. We had one instance with a barrister where he was in that position, and he provided the arguments why, even if when a lease finishes, there is still some sort of conditions and rules and laws around that, such that there is a very strong arguable position that an enforceable undertaking is still in place. However, if it drags on for a period of time, not just normal month to month, but actually, goes on for a period of time, there is an argument that that enforceable undertaking tends to wane, and so there is a danger that the actual property can actually become an in-house asset. So, look, what I'd be saying to accountants is that where the lease comes to an end, talk to your clients and make sure that a new lease is executed. The other thing I'd sort of say as well is that when you do that, or when the lease has gone for say 3 years, and there's the lease terms say, look, it's going to be a market value review, make sure that annual that rent review is done, and when that happens, just reach out and make sure that that when the trustee reaches out to their estate agent, that the rent appraisal explicitly states whether the amounts that they come up with is inclusive of GST, whether it's inclusive of outgoings, because usually they're silent on that, and it does create problems, especially where outgoings are quite significant. So look, just be mindful about that.
So, Chris, I might just pause you there just before we
Sure.
go on to the unlisted non-property trusts and so forth. We're having quite a few questions come through. Would you like to pause and just answer a few questions?
Yeah, sure.
Okay, excellent. We'll just go to that function for a moment, spend maybe 2 or 3 minutes answering some questions, and then
Yeah,
we'll
sure.
keep going.
All right.
So we've had a question from Anne. Would it be better to value my assets high or low?
Okay, so the correct answer is that you value it for what it's worth. So from a tax point of view, you obviously want it to generally be higher, but then there's also an argument to say, well, if you do that, then a higher percentage of, from the member's point of view, a higher percentage of the member's balance is above 3 million. The more you push above the 3 million or the 10 million threshold, the higher the tax liability is going to be. But then when you actually crunch the numbers, generally speaking, lower is better. But again, it depends very much on personal circumstances. And look, actually, it does raise another point as well. I've had discussions with accountants where if a client has done a valuation, say February 26, for the 25 financials, can that be used for the 30 June 26 financials with an eye to using it for the Div 296 CGT reset? And part of the undercurrent of that is that property prices have actually come down, in a lot of instances have come down, and then or they're not optimistic that they're going to be higher in 2 months, 6 months, so if you get a valuation done like in the coming months, you might end up with a lower value than what the valuation at the start of this calendar year. So the simple answer to that question is, yeah, you can actually use it if it's assuming it's appropriate, and assuming there hasn't been any sort of significant declines that the trustee is aware of. Yeah, you can still use that. So yeah, just something to think about.
Okay, great. Thank you. Michael's just noted that he'd like a list of the online commercial property valuers. So
Mm.
just per what Chris was saying beforehand, after this webinar, we'll issue you CPD certifications. We'll send you a follow-up email, and we'll be sure in that email to include some of the property valuers.
Yeah.
So we'll answer one more question, and then we'll go back to script.
Mhm.
So Adriana has a question saying, my understanding is that super funds not affected by the new CGT rules coming in July 2027. Is that correct?
Correct. Yeah, that's right. Yeah. No, that yeah, it sort of felt like, with the exception of limited recourse borrowing associations, the LRBA arrangements, yeah, which happened after budget night. Apart from that, SMSF's got off scot-free. It's sort of like, the firing squad came in and shot everything, trusts and, corporate beneficiaries and CGT and super funds kind of, we managed to sort of shuffle off the stage until we got whacked with the LRBAs. But no, capital gains, it's still going to be based on, the 1/3 discount. So yeah, that doesn't change at all.
Okay, great. Well, Chris, we might go through to the unlisted property trust and private equity,
Yep, sure.
and then smash through the rats and mice and have 5 minutes of questions at the end.
Yeah, I'll see how it go. I tend to waffle, Sasha, but so I'll power
I
through
have
them.
I have confidence in you, Chris. And we've also had some questions about crypto, which I know you cover in the rats and mice section, just as a heads up.
Yeah, I'll try. Okay, okay, so this unlisted equity, this has I'm probably spending a quarter of my time dealing with this now, even though minority of the funds we audit have got it. Look, there's these private equity type investments have definitely increased in popularity, particularly seemingly for firms in Sydney and Melbourne. And it's a real dilemma getting a valuation for this. Like as I said with property, with this regional commercial property, the ATO don't care what your investment is. They've got this bar. They say you need to, if you want to satisfy Reg 802B, you need to meet this bar. And unfortunately, 80% of the private equity unlisted trusts that we see can't meet that. And it's not because they're bad investments or sketchy or whatever. It's just there is a lack of so sufficient objective data that would keep the ATO happy. It's just the nature of the investments. It's so look, I guess in the first instance I'll say, well, what types of information will keep the ATO happy? And look, the best one is a capital raise, and again, it sort of has to be within that. Or I'd say, sort of 6 months of 30 June, but even potentially sort of 12 months, although, it really depends on a case by case. But if there's been an IPO, like I said, not so much IPO, but a capital raise or a share transfer between two, independent parties to non-arm's length, to arm's length individuals or investors, that can be sufficient. That in a way is like the gold standard, because unless there's some other sort of something else that's involved in that, so that share transfer, that can be reliable sort of information as to what the true worth of those shares are. So they're I guess the gold standards. If it's a mature business, you can do capitalization of income, but you'll need to provide supporting data on an appropriate capitalization rate. I have seen AI used for that, and again, it's been hit and miss. Some has been truly excellent, and so it's targeted to the industry and make references to various finance journals as to what an appropriate capitalization rate is. Others have been rubbish, unfortunately. But I guess the bigger problem though is that the vast majority of this private equity type stuff is it's not mature businesses. It's typically startup type stuff where, well, in the vast majority of instances, they're not making any money. And so you can't capitalize income where they're losing money. It sort of doesn't work. So, yeah. I will say, what some accountants don't realise, if there's been transactions after 30 June, well, that can also be appropriate as well. It just doesn't have to be in the lead up to 30 June. But yeah, look, I will say that very few of the firms we've done, maybe say 20%, maybe even less, probably like 10, actually has some useful information that would keep the ATO happy. And so what do you do with the other 80+% of private equity where there's just nothing? And look, the unfortunate situation is there's not much you can do. And I guess it sort of morphs from being can we come up with some model, or can we scrounge around, or get letters from the CEO of the from the private equity firm. Look, it doesn't work. None of it's going to get it above that cap, and so it becomes more a case of educating the clients and saying, look, I'm sorry, this is what the ATO expectations are. The nature of it's just not going to meet it. There's going to be a qualification, but despite that, there's no mischief. In the vast majority of instances, there's no mischief. It just doesn't meet that requirement. I guess one of the key thrusts when when you're talking to your clients is don't necessarily say don't. This shouldn't be something. You shouldn't be saying, "Look, it's a breach. You're going to have to sell it." Like that kills me when I hear. There was one client. They're involved in it was a health related startup type thing. And it was all solid. It was widely held. It was it was a good investment, perfect sort of vehicle for long-term retirement. I think that the client was only 35. This wasn't going to touch his super money for 30 odd years. And he ended up selling it because he felt so bad about getting qualification. And no, that just that shouldn't be the case. But look, that's all you can really do. And look, I have had some clients say, "Oh, we'll use AI or something." At the end of the day, if the data isn't there, it's just going to spit out rubbish. So yeah, look, there's not much you can really do there. I'll also say as well that some of the sort of unlisted / private equity stuff has been involved in mezzanine finance. That's becoming quite problematic as well now. As there's a downturn, we have seen some fairly high profile instances where these syndicates have lent money to for various investments, and it's gone bad, and so that kind of stuff is actually putting more pressure on an auditor in terms of signing off from a Part B point of view, like in terms of meeting the ATO requirements on valuation. Because if there's a question mark about it, look, we always qualify for Part A because we're not vouching for the stuff, but Part B is a more serious one. So yeah, if you're investing in finance, that could be a bit more problematic.
Okay.
Yeah.
Well, let's move on to the rats and mice for a few minutes, perhaps starting with crypto.
Yeah, well, look, I guess the thing is with crypto, in many ways, it's similar to the unlisted investments in that, look, if you're on a platform, look, that's great. It's not, in most instances, it's not enough to avoid a Part A qualification. In most instances, the portfolio servers do not get an external auditor to review the internal controls. So we can't, it's usually enough for a part, to avoid a Part B qualification, but we're probably still going to qualify for Part A. If it's on a cold wallet and we can't sort of independently verify the holdings, look, that's probably going to result in a Part B qualification as well. Now, I guess the interesting that's happened is that some of the platforms have actually they're sort of developing reports that are able to be given to auditors. I think called attestation reports that we can actually rely on. I think there's actually a company that does it as well, and essentially it's a report that an auditor can rely on, where that company is actually saying, no, look, we can prove that this holding exists and it's in the name of the member. So that's the only sort of change with crypto. It's a highly problematic asset from an audit point of view, but it looks like there is some steps happening that will make it easier to review.
Okay, so why don't we just go through the rest of the rats and mice and
All
see
right.
if we've got time for questions at the end.
Yeah. Look, I'm going to power through this. So again, this is the reason I've raised this is because these are the things that are going to that slow down the audit. First one, bank statements. We absolutely need 30 June bank statements. Data feeds aren't enough. Data feeds on Class we can kind of rely on most of the time, but we still need that 30 June statement, not just for the statement, but for the title of the bank account as well. If you're on BGL data feeds, useless. Can't use those. In that, if you're using BGL, we need all the bank statements. So be aware of that. Term deposits, we need to post 30 June stuff. You've got a $500,000 term deposit and $1 million fund. We don't have anything from 30 June. Look, it's going to, we'll have to qualify in some way. So yeah, get that post 30 June information for us. Signatures, we are still seeing financials and things come through to us where the trustees kind of copy pasted the signature into the, but yeah, look, guys, we can't rely on that. Again, slightly push it back, slows down the audit. Contributions, not too much problems with these. I guess it's only like the biggest problem here is more sort of like downsizer type contributions. If your client's done that, we typically get the form, the ATO form, but we often not getting the details of the actual sale because there's timing issues there. We need to check. So please provide those. ASIC statements for corporate trustees. Look, we need the most recent statement. Most accountants are good on that, but there's still some that don't. Yeah, I think that's pretty much it. Yeah, those are the main ones. Yeah.
Okay, excellent. Thank you. Well, we'll go to a question that's come through from a Krish. Chris, it might be easier for you just to go to the Q&A function so you can read this live because they're quite detailed. If you're not sure where that is, I can read it out to you.
Oh, sorry, this is the crypto and data feeds, is that?
Yep. So he's got a question about crypto and then also data feeds. Yes.
Yeah. Now, look, well, I was looking at the data feeds one first because this is an interesting one. The ATO can sort of come out and say that the data feeds don't replace bank statements. Look, that's a newish position for them. One of the points that the Class sales reps say is, oh no, because there's a report called the GL audit, General Ledger Audit Trail, and you can actually see the entries coming through from the Class thing, see whether they've been automated or whether they've been manually put in. And the belief was, and this was the ATO position for a long time, is that you could actually rely on that. If you've got a report from Class proving that this is based on data feeds, is essentially as good as a bank statement. This position from the ATO seems to contradict that. And this is something I need to sort of get my head around. And it may be that notwithstanding what the Class reps have said, we may have to start asking for the bank statements for those as well. So yeah, that might change. What's this on crypto? No, look, I'm not aware of any crypto platforms that have a Type 2 audit report, but there are, like I said, there's at least one company that is issuing these attestation reports that essentially they are stating that no, this is that crypto holding does exist, and et cetera, et cetera. So you can actually rely on that. I have not seen them. Another auditor had one that I was speaking to, but it demonstrates that there is progress starting to happen for this. In terms of asking trustees for their wallet blockchain, yeah, look, you have to, or you just end up qualifying. Yeah.
Okay, great. Well, we've got time for one last question, which has come through from Valerie. When a property is jointly owned by a member in their own right and the SMSF without a partnership entity, how is the rent to be collected? Banks will not allow for a joint bank account between an individual and an SMSF.
Interesting. Well, I mean, that's not uncommon. I would actually argue the majority of properties held in partnership structure don't have some partnership type agreement that sort of sits behind them. It's interesting. Yeah, look, I have to say it's interesting that the bank rejected that. I've seen plenty where they accept it. In the first instance, I say go and talk to another bank. They should allow for that. And I mean it's one of those implicit partnerships. Yeah, very surprised about that. We have seen some where the fund will collect, they use a fund bank account to collect rent and pay out expenses. And look, that's um, it's a tricky one. If the rent belonging to the other party is reimbursed quickly, you might be okay. But look, I wouldn't encourage that. There is a real danger there. The ATO could come out and say, look, yeah, it's inappropriate type arrangements there. Like I said, I think in the first instance, push back on it and go to another bank. I just don't think it's worth the potential compliance headache of either sticking the money in the fund bank account or sticking the money, even worse, in the member's bank account and having it reimbursed. It's not, yeah, it's just not ideal.
Okay, amazing. Well, you've done tremendously well, Chris. That was a lot of information to get
Yeah,
through
yeah. Sorry, I
over.
sort of feel like I had the fire hose and I just sort of,
Yeah, no,
yeah,
absolutely. No, it
yeah.
really appreciate all your insights as always. We've had a few questions come through. Yes, definitely the recording will be available. So we will send that recording along with the various details as we've talked to over the next few days. So, Chris, I have to thank you so much again for all your wisdom, all of your insights. We've jammed a lot of information in the last hour. And
Oh,
to
thank you.
everyone who's tuned in today, thank you so much for your time. We hope you found today's session insightful, and we'll look forward to seeing you next time.
Thanks, everyone.